Hi everybody, and welcome back to video number 5 on the closing entries. And when we left off, we were looking at how we post those closing entries. And here's a depiction of those closing entries that we just did and how they find their way from the general ledger accounts into income summary, retained earnings and dividends, and revenues. So the income summary account is a temporary holding account, and it gets populated and then depopulated very quickly, as shown here. The expenses go in on the left there, and the revenues go on the right. And as you can see, the income summary always remains in balance as well. And then that balance goes into retained earnings, with dividends being a subtraction from retained earnings, giving us a balance of 28,000. All right, so the dividends accounts are zeroed out, the expense accounts and revenues accounts are zeroed out. Now we show the post-closing trial balance. Again, what we look for here is that the debits equal the credits and that we don't have any temporary or nominal accounts reflected on this item. Only balance sheet items or permanent accounts are shown here. And as you see, that is the case. Now, we have done the 9 steps of the accounting cycle. And I won't go through that again, but you can see that we have done that. And now we show the trial balance before and after the adjusting entries. And then we show our income statement for clean window. Revenues minus costs and expenses give us net income. And then our retained earnings reflects that net income that was just shown in the income statement. We back out our dividends and we get ending retained earnings. Just that easy. And then for the balance sheet, that's everything that we roll over from the adjusted trial balance, with one exception, and that's our retained earnings balance here, which we got from here. The ending balance and retained earnings. Okay, so these were the closing processes. Our service revenue we debited. That has a normal credit balance, so debiting them zeroes it out. We put that balance in the income summary account. All the expense accounts have a normal debit balance, so we credit those to zero those out and put that balance into income summary. That leaves us a balance in income summary of a credit balance of 4,300. So to zero that out, we debit income summary. Now income summary zeroed out, and put that balance into retained earnings. And we do the single step process of debiting retained earnings and zeroing out the dividends with a credit to dividends of $600. And there's the post-closing trial balance. Little redundancy there, but I think you get the idea. Now we're going to prepare financial statements for a merchandising company. And here's our income statement. And they lie a little bit here because this is a manufacturing company. They're manufacturing, so the reason I know that is that our cost of goods sold here is 316,000. Disregard that. This is 316,000. That's what it costs this merchandiser to purchase the goods that it's going to sell to us, like IKEA would. And so it's got some cabinets and things like that. And then it has some selling and administrative expenses below the line, the gross profit line. We normally divide up our operating expenses between selling expenses and administrative expenses, and that gives us our operating income. Sometimes we have other revenues and gains. And here we go. And in this case, it was interest revenue. So that adds. We have some other expenses and losses that subtracts. And our income before income tax is 15,640. We have some income tax, and that gives us a net income. So that's a much more complete income statement, and I think reflects more reality of what you'll see in the real world. So now retained earnings done very simply. We bring the net income over that we just calculated, subtract out our dividends like we've been doing, and we prepare our balance sheet. And again, we just bring over all our assets and liabilities and stock from the adjusted trial balance and the calculation of retained earnings that we just made. And now our balance sheet balances, and away we go. So I think you pretty well know this too as a review. Cash basis accounting from accrual basis accounting. Cash basis accounting, we're going to record everything when we pay it in cash or receive it in cash. That is not acceptable under GAAP as shown here. Not acceptable cash basis. So accrual basis is, of course, in conformity with generally accepted accounting principles, and they recognize revenue when the obligation is satisfied. I call it revenue being earned and expenses when they are incurred without regard at the time of receipt or the payment of cash. All right, let's look at this. Quality contractor signs an agreement to construct a garage for $22,000. In July, it begins construction. It incurs costs of $18,000 on credit, and by the end of January, delivers a finished garage to the buyer. Okay, in February, it collects $22,000 cash from the customer. In March, they pay $18,000 due to the creditors. Okay, so we have some timing issues here. So from a cash standpoint, you can see here where cash receipts are all in February, cash payments are all in March, and we've made a total of $4,000 total over this 4-month period. But from the standpoint of accrual basis, we're accruing all the revenues and all the expenses and showing net income that we've made in January of $4,000. February and March reflect no expenses or revenues. Okay, so we've again reported revenues when they are earned. We've reported expenses when they are incurred. So on a cash basis accounting, I think you can see that this is pretty much distorted as well in here. But all of our balance sheet here, we're going to have receivables, we're going to have our assets properly stated, and our liabilities properly stated, and our owner's equity properly stated, which will continue from January, February, and March. Okay, so sometimes little companies record everything with cash. So Dr. Diane Windsor, like many small business owners, keeps her accounting records on a cash basis. So in the year 2025, she receives $300,000 from her patients and pays $170,000 for operating expenses. And so that results in the excess of cash receipts over disbursements of $130,000. At January 1 and December 31st, 2025, she accounts for the receivables, the unearned service revenue, and accrued liabilities and prepaid expenses as shown. So she has, at the end of the month, at the end of the year, beginning of the year, she had accounts receivable at $12,000. At the end of the year, $9,000. Unearned revenue at the end of the year, $4,000. Accrued liabilities in January of $2,000, but at the end of December, $5,500. And prepaids of $1,800 at the beginning of the year and $2,700 at the end of the year. So how we're going to do this is we're going to go up here and we have $300,000 cash receipts. Our beginning accounts receivable, assuming they've all been collected, we're going to back all that out. We're going to add the ending accounts receivable because we haven't collected that yet. And our beginning unearned service revenue of 0, but we had unearned service revenue of 4,000, and we're going to subtract that out to get to our accrued service revenue of 293,000. That's proper accrual accounting. Okay, everybody good with that? We'll move on. Now, the cash paid for operating expenses, we started with 170,000, but we had a beginning prepaid expense of $1,800, but we added an ending prepaid expense of $2,700. So we're going to subtract that. We're going to subtract beginning accrued liabilities, but add ending accrued liabilities to get our operating expense accrual of $172,000. This $2,600 is going to add to the expenses here of $170,000. So in her case, her expenses are higher than their cash. Her revenue is lower than her cash. So this is a good thing for her from a tax return standpoint. All right, there we go. So here's her adjustments. And finally, her net income of $120,400. It's $7,000 from service revenue and the remainder from operating expense differential. Okay, the theoretical weakness of cash basis. I love the term lubricated by credit than cash. A lot of credit goes on. We do virtually all our credit entries in the real world. Very rarely do we do them immediately in cash. So the accrual basis, not the cash basis, is going to recognize all the aspects of our ongoing transaction. And we want timely information about how that's going to affect our cash flows, though. All right, here we're going to look at adjusting entries that may need to be reversed. Here is a little complex. Our initial salary of $4,000, right? That's normal. That's not going to have a reversing entry effect. Then we're going to have an adjusting entry here and a income summary adjustment here. So now the reversing entry, if used, we would just simply reverse this $1,200 that we did here. The opposite effect. And then we just book our normal salaries and wages expense. But if we, and you'll have to walk through that in your own study time. Here is where we don't use reversing entries. And here we're going to back out the $1,200 from the payable we made back in October, and then charge an additional $1,300 of wages expense and cash expense. I would tell you from a practical standpoint, we would never, ever not use reversing entries. All right, that looks like a good place for us to stop this video. And when we return, we'll take a look at more about reversing entries. Until then, bye for now.